Hello Sector Watchers, welcome to the show. This is the 72nd episode of Sector Spotlight for Tuesday the 23rd of March, recording it on Monday the 22nd. My name is Julius de Kempenaer and I'm presenting to you from Amsterdam in the Netherlands, hosting the show for you as usual. Last week we spent a lot of time answering a question from the mailbag and got a lot of good feedback from that, and apparently people like that and appreciate it, and I like to do it, so we will continue to do that. So if you have anything to share or have any questions or some things that you don't understand about RRG or about what we talk about in the show in general, please do not hesitate to get in touch. My email is on the screen and you can use any of the tools or channels that you can see. If you're watching this on YouTube, use the comment section below. Don't forget to give us a thumbs up. If you're watching it on demand, please use email or whatever channel you prefer. As we spent a lot of time last show, on educational content, answering that user question, I actually spent a lot of time today basically updating all my charts, updating my trend lines, my views, my stuff, and I think about, or what I want to do now is actually go over a lot of charts. So I'm not going to add in any separate segments. I just want to talk about a lot of charts, starting with asset allocation, looking back at last week, then going to the weekly charts, trying to put it into perspective, and I do the same with sectors. And then we'll see whatever time is left, and maybe we can throw in some equal weight or small cap or an individual sector or whatever we have and whatever comes across. So for now, I want to just start about talking about the rotations that we saw last week and then expanding that into a broader view and more detailed for sectors. Let's start with looking back at the rotations as they played out last week. On the left hand side, we start with the asset classes, the usual set of ETFs representing various asset classes. And what we see here is that the benchmark that we use for this universe, the VBINX, actually lost 0.7%, so 70 basis points. On the above, so the outperformers for last week were predominantly the fixed income related asset classes, so corporate bonds, government bonds and high yield, and also the US dollar actually gained a little bit, 30 basis points. And then at the below the benchmark, so the underperformers for last week, stocks and real estate, and especially the two commodity ETFs that we're tracking. And it's quite, I get a lot of questions about this because it's quite funny, as you can see, that the outperformers for this week, so these three asset classes are actually at the left hand side of the chart, inside lagging and moving further into it, while the underperformers for last week, like stocks and real estate, are actually inside the leading quadrant and moving further into it. So it's a very good example of how a trend in relative performance, a trend in relative strength as they are shown on the RRG, does not necessarily match one-on-one with the absolute performance for an isolated time frame. So for the last 5 days, these asset classes have outperformed and these have underperformed. But the trend for those asset classes is in favor of real estate and stocks, while fixed income like government, high yield, corporate bonds were out of favor, or that trend is down on a relative basis. And that's, I think, one of the most important things that you need to keep in mind when you read RRGs and you wonder how it is possible that on a strong trend like VNQ, because this one really stands out nicely, actually is underperforming the benchmark over that time frame. It has everything to do with the trend that VNQ is in right now, and we'll get back to that later on. Now, if we move over to sectors, then we see that the S&P 500 lost 80 bips, 0.8%, and the mix is actually spread out quite evenly. Winner, best sector for last week was communication services, and the worst one was actually energy, which lost 7.5%, as you can see, with a very long and wide tail here inside the weakening quadrant, but still the highest highest reading on the RS ratio scale. If we start the way from the top, healthcare actually rolling over, so it outperformed, and that's that little move that we saw here, and that's now actually, it seems to be coming to an end, so this is like a little hiccup here. Staples actually rolling over. It had a good week, but they started rolling over. And then we got consumer discretionary actually picking up, which is good. That's it's a nice angle moving towards the leading quadrant, outperforming slightly. We've got industrials, which moved from leading into weakening. They still outperformed. They're on the right-hand side of the chart. Then we got utilities, which have been doing pretty well over the last 5 days, a little bit better than the S&P 500, but at the end of the week it started to lose relative momentum. And then at the below the S&P 500 we got materials, we got real estate, and that's interesting because you see the tail of real estate here in the asset classes. It's mimicking pretty much what's happening in the sector. And despite the fact that real estate here also on a sector level is outperforming the S&P 500, it's actually a pretty interesting tail with a pretty interesting heading and a pretty interesting rotation. Technology picked up a little bit, but on this daily scale, it's the weakest sector because it's the lowest reading on the RS ratio scale. Nevertheless, very important sector that we need to take into account and take a look at. And then we have financials and energy, the sectors that were very good over the last few weeks. They now start to lose relative momentum. However, they are still at fairly high readings on the RS ratio scale. So very likely, but we're going to look at that later on, in a temporary setback and not necessarily already moving into a new relative downtrend. But we're going to put that into perspective when we talk about the longer term charts, because we're now going to move over to put all these asset classes and sectors onto weekly charts with their weekly RRGs. I'm going to start with the asset classes because I like the top-down approach, the investment pyramid, where you start at an asset class level, get into more detail, get into stock markets, get into bond markets, and then go into various maturities, and then for stocks go into sectors, and from sectors you go into individual stocks, etc., etc. It's the way my brain works, probably. I don't know. Taking a look at the RRG, we got the longer term picture, and the one thing that immediately stands out for me is the positive tail for VNQ. I mean, that was an interesting tail on the daily, and you can see that it's actually also there on the weekly. So we got for VNQ, real estate, we got a strong rotation on both the daily and the weekly, and that always makes me curious to see what's going on there. So I'm going to spend some time on that one. You also see the rotations for both commodity ETFs rolling over. That's the weakness that we saw on the daily RRG, and then pretty much the other ones are confirming each other. We got ITOT, general stock market, losing a little bit of relative momentum versus government, which is picking up a little bit of relative momentum. But these tails are very short, and that means that their trends are stable. And if I have to translate that into a view, it means that stocks are in a stable relative uptrend versus VBINX, and it's still strong, it's still outperforming, and the vice versa. It goes for government bonds, they are still in a relative downtrend versus VBINX. So despite the fact that the stocks are pointing downward and government bonds are pointing upward, the preference is still really clearly in favor of stocks based on this picture, because stocks are way to the right and government bonds are way to the left. And somewhat similar story goes for high yield and corporate bonds, also both with very short tails. You can see the difference when you look at the tails for the commodity and the real estate and even for the US dollar tail. So there's a lot more momentum, there's a lot more going on in these asset classes with those longer tails. Before I start on the weeklies, if I talk you through the daily chart of the S&P 500 following the rotations on the daily RRG that we just watched. As I said, I redid my charts, I redid my trend lines, and what I noticed here is that this actually here running over the tops, that's a very nice trend line. It's got a lot of touch points, so that's a very reliable trend line. Now this one is absolutely parallel to the top one over there, and then you got this one. So we broke here, we talked about it, and it was caught by that horizontal level. And it looks as if that trend is now, it's broadened a little bit, and because this one here is also parallel to this one and parallel to that one. So market respects that pace, so to say. Now, there's a positive and a negative for this chart. The positive is that this is today, so market already open and again already closed for Monday the 22nd. That's this bar here, and we gained versus last Friday, and it looks as if we have a new low in place here. I call this a level 1 low because it's got one higher low and one higher low there. And you can see that that's a short-term low in place, which is a good thing because it's a higher low. What I don't like, or what I would like to see reversed, is the fact that this high here was not able to reach the upper boundary of that channel. That signals at least some sort of weakness just based on this daily chart, just based on this trend channel. What you ideally want is what we saw here, where the next high pushes against the upper boundary of your trend line and the higher lows are bouncing off the lower part of that trend line. So we still have some opportunities to make that happen if we continue and we have a good week and we push to new highs again above, let's say, 397, and we make it all the way to the upside of that channel. Then there is nothing wrong with this chart. This is just one little thingy that makes me go like, I need to watch this. Other than that, that trend is still up and still going well. Move to longer term charts. If we take a look at the longer term chart for stocks, and this one is the one that I've annotated for ITOT, then you can see that that trend is still pushing higher. We had a little bit of trouble last week taking out that high, maybe related to what we just saw on that daily chart for SPY, but the series of higher lows is still intact, and for an uptrend that's the most important fact, that all these lows come in at higher levels. If we put it relative to VBINX, then this obviously is a very strong sign. This relative uptrend is still going higher, and it's confirmed by the RRG lines. The only thing here, what you can see, and again it's trying to see if there are any warning signs, is that we are at a relatively high level of relative strength in terms of our ratio. We haven't seen that level for 5 years, other than earlier or late 2020. So we're at that level. That seems to be some sort of a maximum where you get some sort of a rollover, some sort of setback getting into place. If that's what it is, some sort of a setback, then there is no problem. The only thing that this will do here is create a short tail on the RRG that continues to sort of rotate on the right hand side, stay stable, and that's just what it is. It's just a stable relative uptrend, and for the time being that's all there is to see on this chart, a stable relative uptrend with ITOT outperforming VBINX. If we take a look at the counterpart, the government bonds, then there's a lot more to say. Well, there's a lot more. It's more pronounced, I should say, on this chart. because we clearly are in a downtrend and we're dropping like a stone still. And the first level that I'm watching for support is the area where we found support late 2019. That's already more than a year ago. And that is the area around 25.90. This is 26. And you can see the effect on the relative strength that is still very much in a downtrend. And you can see this is the opposite of ITOT, where the RRG lines are stable, moving parallel, which causes these short tails, and the tails on the RRG to remain pretty much in a static position, rolling over on the left-hand side and stocks on the right-hand side. In terms of asset classes, these are two charts that I talked to you a while ago after the elections. This one shows ITOT GOV, so stocks versus bonds, after the elections of 2016, and you saw the market going higher, and I compared it with November 2020. I've just added a little bit of new history, or extended the history a little bit to March 2017, which is pretty much where we are now, March 2021. And so we can see what happened in March 2017. So make a mental memo of this chart and then see what it looks right now. And you can see that uptrend here, stocks versus bonds, is in a very, very stable uptrend. Very nice rhythm of higher highs and higher lows. And it's continuing. So basically the message that we're getting from this chart is that stocks continue to outperform bonds, and the fact that stocks maybe sometimes are slowing down is countered by the effect that bonds are dropping even more rapidly, making stocks still the more interesting asset class to stay with. Finally, I want to do the commodities. We saw some weakness kicking in here on the daily, and also on the weekly you see the effects of the chart rolling over. And you can see that happening here, where GJP is running into resistance around 25.50, and you see a similar effect with GSG that is running into this gap area, and you can draw a trend line roughly around here, and you see that coming into play. I was going to say finally we see some weakness, because we had this massive run up, and I don't really like to chase these trends, but what I do like is the longer term turnaround that we're seeing developing in commodities. And when you go back to the monthly charts that we do every first Tuesday of the month, we'll do it again in 2 weeks' time, then you'll see that these commodities are actually on a big turnaround as it looks. And so I'm actually waiting for a setback on the weekly to get a good entry point and make it a real confirmation of that long-term turnaround that we currently see in the commodity markets. And now move over to sectors, and I want to start with real estate. Whatever way I would work my way through these sectors, alphabetical, performance, etc., it usually gets me in trouble at the end, because then I have not enough time to discuss the real point that I want to make. And for this week, the real point that I want to make is about real estate. We already saw the tail of VNQ on the asset class RRG. That's right here. So that's a pretty strong rotation. And if we look at the sector RRG, then you will see that XLRE, which is the real estate sector, is showing a similar rotation. Obviously it's differently positioned, but that's primarily because of the difference in benchmark. but the direction and the angle of the tail and the length of the tail, that's all very similar. And that makes XLRE an interesting sector to watch, especially also because on the daily RRG, as we saw earlier at the start, XLRE is already showing a very nice rotation on the daily RRG. Now if we bring that to the price chart, then we see that real estate is, the XLRE is actually in a sort of sideways, trying to break out, trying to push higher. We had this sort of correction here at the end of 2020. We broke out of it and we're now pushing against those highs, and if that gives way, then 40.42 is our next stop. That's our next area of resistance. What I really like is the fact that relative strength has stopped declining. So the downtrend in relative strength has sort of stopped, and that's being picked up by the improvement in the RRG lines, where the RS momentum is already pushed above 100 and it's now starting to drag RS ratio back up. Breaking this falling trend line here, it's a dotted line. I try to draw my trend lines, and you'll see that while we work our way through our charts, the more pronounced, the more reliable, the more emphasis I put on those trend lines. When I dot them, when they're thin, when they're opaque, then I put a little bit less emphasis on it, or I think they're less reliable. That's how I try to actually sort of give weight to my trend lines and to my trends. Now, if we look at VNQ, you see that although they're the same sector, the same asset class, you see a little bit of difference in the price chart, because I actually think that VNQ is looking a little bit better than XLRE. There are different indexes covering the same asset class, but you can see here that we're making a new series of higher highs and higher lows. It looks a little bit better, and you can see here that this bounce of support is a little bit more pronounced, and you see that this is already they're both going above 100. So nevertheless, the overall picture is improving for real estate. Makes it interesting, especially because it's on 2 time frames. The only thing, and we're going to look at that next week when we look at seasonality. The previous show on seasonality was called a seasonal surprise for real estate, and that was due to the fact that the performance for March was actually sort of standing out, and the expected performance based on seasonality for April is a lot less than for March. We're going to look at that next week. For now, I think you should really keep an eye on real estate, and there are probably a couple of good individual stock picks in that sector to be found as well. If we work our way through the various sectors, then let's have a look at communication services, because communication services is actually doing what it was supposed to do, also again based on seasonality. It's continuing to do well, and that chart also still looks pretty strong. Let me bring that up right here. So here we've got XLC, and you can see that's actually pushing against that upper boundary of that trend line. Remember when we talked about S&P, where the S&P didn't reach the upper boundary of that trend line? Well, XLC is actually now pushing against that upper boundary of the trend line, which is confirming the current strength. And the relative strength line itself is very strong. There is no problem at all there, and that's obviously dragging the RRG lines higher. So communication services remains one of the leading sectors, no doubt about it. The other 2 sectors that are still leading are energy and financials. They're still way to the right, very high readings on the RS ratio scale, but they're both rolling over while inside leading. And what that means is that the relative trend is still up, but it's losing a little bit of power. The angle, the pace of the rise is leveling off a little bit. As of now, because of this, nothing to really worry about. Just sort of a temporary setback. That's the way I see it, and that's if we look at the chart here, you can see how and you can see why. We had this very nice run up. We had that very nice break of resistance here. And we're now going into an area where market had a little bit of trouble during 2019, so not a surprise. And also after this break, a setback is the market can handle a setback like that. And that's what it's going through right now. You can see it's breaking that downtrend in relative strength. The longer term trend is still turning around. We've had that first move higher. And remember, when we talk about those rotations that continue to rotate on one side and they go through temporary setbacks, I think that that's what's happening with the energy sector right now. So we got that price decline possibly going down to test support between 42.5 and 45. And relative strength just needs a little bit of a breather and can then pick up again. If we look at financials, then we will see, where's financials? Here's financials. A similar picture. Again, this one also touched the upper boundary of the trend channel, pretty strong, and you can see that it's now bouncing off its long-term resistance in relative strength, but we have this bottom formation here that's being completed. RRG lines are way above 100 for the first time since 4 or 5 years. So I'm looking at this as a temporary setback, both in price and in relative strength. And very likely we will get a better entry opportunity at a later stage. Let's see what else. We have industrials here moving almost vertically. And if we look at the chart, the price here, then you can see that that trend is still there. It's running into trouble in terms of relative strength. Price-wise, in the middle of the trend, no problem, enough room to breathe. Just wondering to see whether we can continue above this resistance in relative strength, because that's what we need right now to actually bring XLI, bring the tail back into the leading quadrant. So I'm going to watch XLI in coming weeks to see more in terms of relative strength than in terms of price. Price is still good. Relative strength needs to push above its resistance level to make this tail move into the leading quadrant again. Let's look at our baby here, our technology baby. That is not doing what we want. It's continuing its rotation into the lagging quadrant. We had some improvement on the daily chart. Let's have a look at the weekly. It looks as if the real weakness has stopped a little bit, but we did break out of this tight range here in relative strength, and the RRG lines are not sending strong signals. They're very close to 100, so it's sort of seeking its way. In terms of price, we just bounced off support and started moving higher again. So that's the positive thing. So we really need price to actually, let's say, get back above 135 on XLK to bring back that uptrend in price and hopefully get that relative strength back on track. If that does not happen, then technology will continue to weaken and push further into the lagging quadrant. Wrapping it up, discretionary, one of the weaker sectors at the moment, especially in the large cap. Read the blog of last week and your daily 5 that I did last week on Thursday, because I do think that XLY is actually very weak on relative strength. But if you look at the equal weight sector and you look at small caps, discretionary is actually one of the stronger sectors. So it's especially on the large cap size that you got to be careful with XLY, and that's obviously because of the weakness that we've seen in Amazon and in Tesla. There are pretty good stocks inside the discretionary sector at an individual level. I got to wrap it up. This was Sector Spotlight for this week. Remember, Sector Spotlight airs every Tuesday from 10:30 to 11 a.m. Eastern. Please stay safe. If you have anything to say, use the comments below or drop us an email, and I really hope to see you back again next week.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.